long-term perspective and weathering the storm, especially if you take on more risk in something like emerging markets. You talked about your mom a little bit. I mean, we frequently get challenged after these webcasts to say, okay, but I'm a couple years from retirement, or I'm in retirement. So, Maureen in Pennsylvania asks, how can I insulate my portfolio from this uncertainty because my time horizon is much shorter? I mean, how do you, it's great that in the financial crisis your advice to your mom was to stay the course, but what do you tell retirees on a regular basis?
Well, again, this gets down to your basic asset allocation. If you really can't withstand a fair amount of volatility in your portfolio, and which typically as you're getting closer to retirement may be the case, then you need to have a pretty healthy allocation to fixed income, because fixed income is the ballast, if you will, to the equity markets. Now again, if you take an average couple age 65, there's a better than 50% probability that one of them is going to live more than 25 years. Mm-hmm. So you do have to have even in retirement, you have to have some hedge against inflation. You need growth. But in a sense, the less volatility you can handle, mm-hmm. the more you have to have in fixed income in terms of balancing your portfolio.
And that can be controversial for people today, especially when the press is saying there's a great rotation going on. Everyone's moving from fixed income to equities, right. And you should get out of bonds now. Rates are going up. But people have to realize bonds are not there to drive your growth in your portfolio. As Bill mentioned, that look, equities, they're the wind in your sails.
Sure.
Right? They're the ones that's what pushes you forward, gives you growth. But like wind, it can be stormy. It can be very stormy, and Bill mentioned bonds are the ballast. They're the ballast in your keel to keep the mass up and the keel down. Mm-hmm. So don't mistake it by saying, oh, well, bonds aren't going to return much. They're there to actually reduce the volatility of your portfolio, to zig when equities zag.
Mm-hmm. The other thing that comes up in this discussion, and I'm sure we've gotten some questions on it as we're talking, is, hey, that's great, but in a rising rate environment, when I see the value of my bonds go down.
Right.
And the answer to that is yes, you will. If you're looking at the value of your bond fund, if rates go up tomorrow by 50 basis points, you're going to see a decline in the value of that portfolio. But what you really need to think about is, as long as your time horizon is longer than the duration of your bond portfolio, you actually want rates to go up, mm-hmm. because you're going to be reinvesting at higher and higher yields. And actually, when you do the math on this, you're better off. And this is completely contrary to the way most people look at bond funds.